Hello everyone, Karl Weiss with Fairway Independent Mortgage, and today of course we are joined by the esteemed CPA, Mr. Seth Fink, who's going to take us through some of the additional items on the 2018 tax code changes. So thank you again, Seth, for agreeing to do this. One of the things that we were talking about as it relates to the 2018 tax changes is sort of the difference between the standard deduction, right? How that's changed. You know, it's doubling from 17 to 18. But what that really means essentially is that people are no longer going to be able to itemize in as many numbers. And that might, some people might take that to say, hey, you know, buying a house really is kind of irrelevant now because we can't itemize maybe the mortgage interest deduction, mortgage insurance, real estate taxes, things along those lines for maybe, you know, the moderate to lower income earners, you know. And so I wanted you to touch on that a little bit to kind of walk us through some of the mechanics of what you think
Certainly.
that'll entail.
For most people, what itemized deductions includes things like your mortgage interest, your real estate taxes, mortgage insurance premiums, medical deductions over 7.5% of your income, as well as charitable contributions, miscellaneous deductions like tax prep fees and administrative advisory fees, or unreimbursed job expenses are no longer deductible for 2018. So the sum of all those other itemized deductions has to exceed the standard deduction for you to take the higher of those itemized deductions. With the married filing joint, for example, threshold going up to $24,000 for 2018, many people who even could itemize in 2017 will no longer be able to for 2018. So what that means is for a lot of folks, the amount of mortgage interest they pay or the amount of charitable contributions that they make no longer have an impact on their taxable income. And so one of the primary selling points in the past for being a homeowner versus being a renter was, hey, I get a tax deduction or a tax break for being a homeowner. I'm being incentivized.
Correct.
But if your income doesn't provide for you buying a home and having the amount of mortgage interest, that would now push you over that limit to itemize, where you're still getting a standard deduction. There's no longer a taxation-related incentive for you being a homeowner. But we look at it from a couple different perspectives, which is no matter what, your tax bill is going down. And we've done a bunch of scenarios already of people across the board. Some people, their tax bill is going down a little bit, some people it's going down a lot. We have yet to come up with a calculation to show where someone's tax bill is actually going up as a relation to the new tax changes. Not to say it's not going to happen, we just haven't come up with a scenario yet to show that. So your tax bill is going to go down, which does mean you're going to have greater purchase power when it comes to buying a home. But we look at it from the standpoint of home ownership is really two other things as well. Number one is you're going to get the appreciation of that asset that is increasing in value. So when you buy that home, you're buying it at today's prices, holding on to it for some period of time with the hope that, hey, that value of that home is going to increase.
And that's right. And let's compare that to renting, right?
Yes.
For a renter, you're paying someone else's mortgage typically,
Yes.
And you don't have any equity position in that property.
Right. And the second position there would be that it's inflation protecting your purchase, meaning your mortgage payment's not going to go up every year, maybe except for the small component for your real estate taxes, but the payment itself doesn't change on a fixed rate mortgage. Where if you're renting, whether it's an apartment or it's a home, your rent goes up every single year based on market conditions. So by buying a home, not only can you participate in that appreciation instead of your landlord, but also you have the ability to lock in your pricing at today's dollars so that as you earn more in your career, more of your earnings power is going to other things other than your cost of your housing.
Correct. Yep. You get to leverage down the payments over time, and that's a huge thing. I think, you know, as we look at some of the real benefits.
Yeah.
You know, here's the thing: over a 30-year fixed mortgage, at the end of that, you own it free and clear. So now you have all the equity. And you know, when we make a comparison between renting and owning, the biggest component of the rental piece is we don't know how much the rent is going to change over 30 years, but we don't ever get to own anything. So those are huge components, I think, that are really impactful, and thank you for sharing those. You know, again, tied with, you know, one of the ways to offset with those lower tax bills that Seth was talking about, you know, we want to take advantage by changing our withholding, doing some calculations early in the year to figure out what it's going to look like, and then change your withholdings so that every paycheck is a little larger. That, in essence, brings up that time frame of when you may have gotten a refund from the April time frame of the following tax year to every pay period during the year.
Right.
And that's going to help you manage monthly mortgage obligations as they continue. Now, as a quick note, because I'm licensed in a lot of different states, this topic is really an Arizona specific based topic, because traditionally in Arizona, our real estate taxes are pretty low. So for the people that, are clients of mine in Illinois, you may get beyond that $24,000 standard deduction easier when 2/3 of that $24,000 is absorbed by real estate taxes.
Right, but keep in mind for 2018, for state income taxes and state real estate taxes, the maximum between the two you're allowed to deduct is only $10,000.
It's $10,000, that's right.
And that's it. So for people that live in high income tax states, they may not get a benefit for the real estate taxes, or vice versa. An average home in places like Texas could be $10,000 or $12,000 a year in real estate taxes, and it maxes out at $10,000. Arizona, we're lucky because our state income taxes are lower and our real estate taxes are lower. For the average taxpayer, they're not going to exceed that $10,000.
Okay, that's great information. And for people that want to take a look at this and maybe have been along the lines of either, they haven't gotten great advice before, they're using a big box store or a CD to actually compute their taxes. Tell us a little bit about, what kind of client you would accommodate this tax year. Number one, do we have some openings still for tax clients?
Certainly. In our firm, what we look for are value-driven clients who look for a trusted advisor. Our firm doesn't sell the commodity of tax return preparation services. What we're looking for are people who want that relationship. They want that help in calculating my future taxes and looking at tax planning down the road, not just that I just need to get my taxes done sort of commodity standpoint. We find ourselves in a place where we help folks who are business owners. We help folks with more complex tax situations because we can add more value, but we certainly help people of every socioeconomic group. They just have to understand that what we're trying to do is add value. We're not just creating that commodity.
Right, we always have the choice of where we shop, but I will say that, Seth's firm, that value-driven proposition is really one in which the whole team takes to heart. It's not designed to be the Walmart of tax planning. This is more the Macy's and Nordstrom of tax planning, because with the expertise that comes along, it takes more time. And it takes a lot of knowledge to understand the tax code itself. And how it applies to each individual person. They have to put a lot more time per client in to look at options. I mean, that stuff takes time, and you can't get through 1,000 returns in a month when you stop and you read and you take time to see how it applies to everybody's specific their circumstances. So again, thank you very much, Seth. Really
Thank you.
appreciate it.